Hey everyone, welcome to Investing for Dummies. I'm your host, Pasha IRL, and today we're going to try to make investing as easy as pie for you. Today we're going to dive deep into the investing world and cover some of the terminology you'll need to become an informed investor. We'll break down this video into 3 difficulties. Let's head over to the first one. Actually, before I head over there, is it cool if you guys hit the like button real quick? Appreciate it. Alright. What the heck? Alright. I guess let's get started with the basics. Stocks. Now, stocks are pieces of ownership in a company representing your claim to a share of its assets and earnings. When the company performs well, the value of your stocks may increase since the overall value of the company increases, and you might actually sometimes receive a portion of the company's profits as well. Bonds. Bonds are essentially loans you provide to corporations or governments. When you purchase a bond, you're lending money to the issuer who promises to pay you back with periodic interest payments and return the principal amount at maturity. Diversification. Now, diversification is the key to reducing risk in your investment portfolio. By spreading your money across various asset classes, industries, and regions, you're not putting all your eggs in one basket. This approach can help protect your investments during market turbulence. Risk. Now, investing involves risk, which is the possibility of losing money on your investments. Different investments carry varying levels of risk. Generally, higher risk investments have the potential for higher returns, but they also come with a greater chance of losses. What is a bull market? A bull market is a period of rising stock prices and investor optimism. In a bull market, economic conditions are typically favorable and investors expect continued growth. It's a time when the bull charges forward, which propels stock prices to go higher. Bear market. On the flip side, a bear market is a period of declining stock prices and investor pessimism. It usually occurs when the stock market experiences a prolonged downturn of 20% or more from its recent highs. Bear markets can be challenging for investors, but they also present opportunities for long-term investors to buy quality assets at lower prices. All right, I think it's time to bump it up a notch. Oh, no way, dude. Oh man, alright, fine. Let's do this. Compound interest. Compound interest is the concept of earning interest not just on your initial investment, but also on the interest you already earned. Over time, this compounding effect can actually significantly boost your investment returns, making it a powerful wealth building tool. What about exchange traded funds, or ETFs? ETFs are investment funds that trade on the stock market, just like individual stocks, but they pool money from multiple investors and invest in a diversified portfolio of assets, such as stocks, bonds, and commodities even. ETFs offer liquidity, diversification, and low expense ratios, which is basically your fee for owning it. Now, mutual funds, they're very similar. They're funds that are professionally managed investment vehicles that pool money from multiple investors and buy diversified portfolios of stocks, bonds, and other different types of securities. They offer ease of diversification and are suitable for investors seeking for a hands-off approach to investing, but they could actually come with a little bit more fees. What about capital gains? Now, capital gains are the profits realized when you sell an investment for more than you initially paid. These gains can be either short-term, which is investments that you held less than a year, or long-term, which are investments that you held for more than a year. And each of these have different tax implications. Dollar cost averaging. Now, dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals regardless of market conditions. So like once a month, for example. And this approach actually helps reduce the impact of market volatility on your overall investment performance. Doesn't sound too bad. But what's an asset class? Asset classes are categories of investments with similar characteristics and behaviors. The main asset classes are stocks, bonds, real estate, and cash. Diversifying across various asset classes can actually help balance risk and return in your portfolio. I'm pretty sure this is way too easy for you guys, so let's head over to the hard stuff. Oh, would you look at that, we're back. It's time to level up. Let's get to the hard stuff. Market capitalization. Market capitalization, or market cap, is the total value of a company's outstanding shares of stock. It's calculated by multiplying the current stock price by the total number of shares outstanding. Market cap categorizes companies into different sizes, such as small cap, mid-cap, and large cap, which can help investors assess their risk and growth potential. Fundamental analysis, a bit of a general term, but fundamental analysis involves evaluating a company's financial health, competitive position, management team, and growth prospects in order to determine its intrinsic value and potential for future earnings. It's a method used by investors to make informed decisions about which stocks to buy or sell. Options. Options are financial contracts that give investors the right, but not the obligation, to buy or sell an asset, such as a stock, at a predetermined price within a specified time frame. They can be used for hedging, speculation, or income generation, but they also involve a higher level of complexity and risk compared to traditional stock investing. So I would not recommend getting into this unless you are very knowledgeable about it. Liquidity. Liquidity refers to how easily an investment can be converted into cash without causing a significant impact on its price. Cash is the most liquid asset, as it can be readily used for transactions. Now, real estate, on the other hand, may have lower liquidity because it requires a buyer and it might take time. Dividends. As we mentioned earlier, companies can make payments to their shareholders, usually from their profits, which are called dividends. Dividend-paying stocks can provide a consistent income stream, and this can make them attractive to income-focused investors. Price to earnings ratio. The PE ratio is a valuation metric that compares a company's stock price to its earnings per share. It helps investors assess whether a stock is undervalued or overvalued relative to its earnings potential. A higher PE ratio may indicate higher expectations for future growth, while a lower PE might suggest a potential value opportunity. So the overall goal of investing is to achieve financial growth and security by growing wealth through diversified investments, surviving market fluctuations, and capitalizing on mispriced opportunities. The wisest investors will seek long-term growth, passive income, and financial independence in order to enjoy life and preserve their assets from the effects of inflation. Bravo! You've conquered the investing terms from easy to hard, and now you're well equipped to venture confidently into the investing world. Remember, investing is a journey, and learning is the key to success. Thanks for joining me. And know that if you felt like a dummy, be proud, because now you know more than most, and you'll never need to feel that way again, honestly. So be sure to subscribe to the channel, share this video with your friends, and other than that, I wish you happy investing, and I'll see you in the next one.